Well, good evening, ladies and gentlemen. How we doing? Spectre here for another edition of Midnight Rider. Now on the 6th day of April. Good to have you aboard. Hopefully you guys had a good resurrection weekend. And this night we're going to talk a little bit about some financials. Tonight on the broadcast, we're going to talk of a couple different scenarios that have been playing out here. One of which is taking a look at Greensill, what has been going on with that outfit in the European Union and how that is playing out, as well as Archegos here. And who got caught up in it, who got lucky, etc., etc. We're going to take a look at it here. And ultimately, what is going on with financials between now and the end of the month? Some interesting things playing out. So we'll see you back here on the other side. Warning. These social media platforms may be hazardous to your health. Censorship kills. Pain coming. This has been a PSA by Breaking Spectre. Alright, welcome back everybody. Like I said, in case you are just joining tonight, I'm going to talk of a couple of different scenarios playing out in the old financial world with the old hedge funders and whatnot going on with Archegos, Greensill. We're going to take a look at the scenarios that have played out here over the last month or so and where things currently reside and what sort of Banksters are currently ensnared by this. But before I do, I want to thank everybody for joining. If you are over on the YouTube side, good to have you aboard. Twitch appears to be up, although it was giving me fits just before. D-Live, we are up there. Of course, we've got our friends over on the Tiger Network as well. And recently added here, we've now expanded to Trovo Live as well as Vaughn Live, and you'll see the addresses for that down on the ticker. Should something ever happen, of course, we'll get up and running over there. So tonight is the inaugural broadcast on both of those platforms as well. Alright, that being said, let's jump right in here this evening. And of course, I'm going to take us back to around the March 26th time frame when Zero Hedge kicked this out. It says, is a massive fund liquidating stocks. I guess that was a little bit of a canard, a canary in a coal mine, if you will. Something odd is going on. During today's U.S. session, we noticed an unusual number of large block trade headlines. Shopify, 762,000 at 1,000. Farfetch was 26 million at 45, and there were a number of others here as well. Discovery, 16 million at 45 to 50, and Disc, 32 million 40 to 44. VIP Shop with 32 million at 27.60. Tencent, Baidu, same sort of scenario there. Says that is around $7 billion worth of block trades executed in the open and the morning session alone. After reaching out to one desk, as we're told, someone is liquidating, and another desk suggested the trades were a result of forced deleveraging. And it says lots of speculation as to the seller. Is it Kathy Wood? We do not think so, since very few of these positions are in her ARK fund. One other suggestion was that it might be Credit Suisse, liquidating positions to fund the bailouts for the angry Greensill deal clients. And we're going to touch upon that. Says all 6 of these positions are among CS Credit Suisse's largest positions, but the size of the blocks dwarf Credit Suisse's positions, so it's not them. So the question is, who is it? And again, this was back on the 26th. Well, it didn't take too long for things to start to shake out, and we find out on the 28th, prime brokers were pounded. Credit Suisse, Nomura crash, and Archegos margin call shockwave. And I'm going to touch here briefly on what exactly happened in a subsequent article. So just follow along a little bit here. It says just around the time Nomura closed down 16.3%, its biggest drop on record after warning it faces around $2 billion in prime brokerage losses tied to a single U.S. client, the now infamous Archegos Tiger Cub hedge fund. Swiss banking giant Credit Suisse was also swept up in the Archegos vortex after the Swiss bank said it faces a potentially highly significant loss from a U.S. hedge fund client defaulting on margin calls, sending the Swiss bank's shares plummeting as much as 16%, the most since March last year, and wiping out all of 2021's gains. And that's just one Bankster, the old Credit Suisse here. Says while the actual loss number was not defined, estimates pegged it at around 2 to 3 billion ballpark, and of course we'll find out it was actually much more than that and additional fallout, but stay with me here. It says in one commenter said that Credit Suisse lost its entire year profit because it was outsmarted by Goldman, aka the sharks of the street, and by a one-day. And here we see there are 3 ways to make a living in this business: be first, be smarter, or cheat. And I think we know how that fares. It says while at this time it's premature to quantify the exact size of the loss resulting from this exit, it could be highly significant and material to our first quarter results, the bank said in an emailed statement without naming the fund, although the name was quite clear. Credit Suisse also said it was in the process of exiting positions after the client default. And so it went to earlier. Here was the statement out of Nomura. Says possible loss arising from business activities. Yeah, just some normal transactions, little business activities. Nomura Holdings today announced that on March 26, 2021, an event occurred that could subject one of its U.S. subsidiaries to a significant loss arising from transactions with a U.S. client. And I won't continue that. You kind of get the idea. There we saw what happened to Nomura back on the 28th. The news, incomplete as it may be, was enough to send Nomura stock crashing 15%, wiping out all March gains and the biggest one-day drop in a decade. And of course, Diogenes says the brokers became involuntary principals here as they own the shares outstanding on leveraged swaps to their clients. If the client can't meet the margin calls, the brokers take huge losses. For example, Nomura quote-unquote owns 10 million shares of GSX as of 12/31/20. And another tweet here by Zero Hedge says now that the entity liquidating media/Chinese tech stocks is no, will the market 1 keep pressing them lower to hurt Huang's idea dinner pals, or 2 ramp them as no more selling pressure? And of course, there were some other ones net that were being sold off as well. Viacom CBS holder said to offer 45 million SHR block via Morgan Stanley. Morgan Stanley was shopping a large block of Viacom CBS Inc. shares on Sunday, according to a person familiar with the matter, the latest in a flurry of block trades that began before the weekend. About 45 million shares were offered Sunday on behalf of an undisclosed holder, the person said. The media giant was also the subject of at least one large block trade on Friday through Goldman Sachs, a person familiar with the matter told Bloomberg at the time. And of course, like I said, we talked about Viacom, sold $3 billion in common and preferred stock. That was one of those. Tencent just announced $1 billion share buyback to offset just this liquidation-driven drop in the stock price. Just how bad is the pain as more prime brokers issue urgent margin calls, and how widespread will the liquidation chain stretch? All right, so if you're not familiar with stocks and things of that nature, this article is going to be a good way to help understand what exactly is going on. And I'll have a video here momentarily to also kind of explain this to the common man who probably isn't as versed on this. It says how the leverage at Archegos Capital brought banks to their knees. Pretty good article out of Capital Mind here. Says the tail is wagging the dog again. As it happens, yet again, the world's financial system is currently in yet another turmoil because some character borrowed money to buy stocks, and those stocks have fallen just a little again. In today's edition, we have this madness pop up in the U.S. markets. So it explains this unwinding of Archegos Capital. Says there's this man named Bill Hwang. He is a tiger cub, having worked for the hedge fund named Tiger, run by Julian Robertson. Hwang runs New York-based Archegos Capital. Archegos was a family office of Hwang and ran capital of around $10 billion, it seems. But the real exposure was much more. What Hwang did, it seems, was that he didn't buy stocks directly. He bought a certain derivative instrument called a contract for difference, or we'll call it from here out a CFD. In a CFD, you deal with a bank and say, listen, if the stock goes up, you pay me the difference, and if it goes down, I'll pay the difference. The bank then takes the underlying position in your name and hedges out the risk. The stock is held by the bank, not in your name. And that's probably the key thing right there. You technically don't own the stock. Basically, you're leveraging it. The bank continues to hold the actual security. It says effectively, Hwang could build large positions in certain stocks without revealing that he owned those positions. If he had bought stock directly, anything above 5% had to be reported. But it wasn't because of the CFD trick. And I guess one might say this is a little bit of a workaround to those who are familiar with what sort of positions you can hold if you're on a board of directors or a major investor in any company whatsoever. Typically, there's limitations on how much stock you can own before you're pretty much declared a monopoly or whatever, to have too much of a stake, let's say. But that wasn't the only trick. Hwang had $10 billion. His positions were $50 billion. How do you get 5x leverage? The 5x multiple was leverage offered by large banks such as Nomura, Credit Suisse, Morgan Stanley, and Goldman. He'd put his dollar and they'd lend him $4 against the security of the very stocks he would buy through a CFD. All it took was for Hwang to ensure that he'd pay up if the stocks fell down. And the stock kept going up rapidly in 2021, with one of them, Viacom CBS, moving from $36 to $100 between the start of 2021 to March 22nd. And here we see Viacom actually hitting up during that period. Then the fall, just 3 days, took it all down. As the stock went up, it appears that Hwang kept using the money earned to buy more of these stocks, such as Viacom and Discovery. He also owned shares of Baidu, Tencent, and a bunch of Chinese tech companies. Take Viacom. Between March 23rd and 24th, the stock fell from $100 to $67, a 33% fall in 3 days. Now think of this. You have $100 multiplied to $500 by leverage offered by the banks. You own $500 worth of Viacom, but not in your own name, as a CFD. So the shares are owned by the banks and kept as collateral. The stock falls 33%. Effectively, you've lost $150. You owned only $100 in the first place. The bank says, "Hello, uncle, give me the extra 50 and then some more to cover for volatility." You don't have it. The bank panics and starts selling the stocks like crazy. Just on Friday the 26th, the banks dumped shares of the companies that Archegos had exposure to, more than $20 billion worth. Viacom fell to $48, another 27% lower. Discovery, Baidu, Tencent, etc. all fell rapidly. Nomura and Credit Suisse give major warnings. Nomura, one of the banks involved in this mess, has said it might see a loss of $2 billion after a U.S. hedge fund defaulted on margin calls. Credit Suisse, too, announced there was a problem but didn't reveal the size of the loss. So the takeaway, for banks, the risk is free. Now, we don't know the extent of the problem in other people's books yet, but the numbers don't look insane yet. $2 billion or even $5 billion will not kill any of these banks, unless there's a cascade effect. When the massive selling here causes some other funds to unwind and die, which causes more selling and so on. Currently, it doesn't appear like the world has come to an end, but it gives you a clear idea of how the banks are all working hard to ensure such a day will come. The leverage, even only 5x, offered against something as volatile as stocks is the real problem. And then, size. At $50 billion, the positions aren't small enough to ignore. At 5x leverage, all it takes is 20% fall to kill you. If the underlying stock has already risen 300% in 3 months, the bank should have been hiring ambulances to run around the buildings with their sirens blazing, hoping that someone would listen. Plus, to hide all this, as a CFD, which masks the true ownership of the company, is even worse. And the banks actively knew they were doing this. But who cares? If they fail, it's a taxpayer's problem. If they make money, they make money. It's the only lesson the bankers have learned worldwide. No matter how many books have been written on LTCM, Bear Stearns, the 2008 Great Financial Crisis, and whatnot, the world's banks will simply not learn. So, again, as always with the bankers, they privatize gains but socialize the losses. And that was primarily what happened in 2008 at the time when that little ditty unwound. And of course, we find out that, we got to have these banks. They're too big to fail, right? Well, are we repeating the same mistake except on a grander scale at this point? Perhaps. Alright, so that being said, let's get into this portion here. It says Credit Suisse fires risk chief, others as Archegos losses climb to $5 billion. This was just yesterday. So shortly after Credit Suisse dumped its last blocks of the so-called Archegos stocks Monday evening in the U.S., and in the middle of the night in Switzerland, the Financial Times confirmed rumors from earlier in the day by reporting that Lara Warner, Credit Suisse's chief risk and compliance officer, had been fired, along with 2 other senior bankers. And here we saw the block portfolio launching, Viacom, VipShop, Farfetch, kind of their positions in that. The others included Brian Chin, head of Credit Suisse's investment banking division, and Paul Galeotto, head of equities, sales, and trading. Insider reported Galeotto's departure, while the FT reported on Chin and Warner. Chin was fired since the prime brokerage unit was part of the investment bank. Now, mind you, folks, had this been on the other foot and they actually would have made out like bandits and nothing would have happened, these guys probably would have been put on a pedestal. But because now this thing is unwound and they got caught with their pants down, then somebody's got to pay the price. While Warner wasn't directly involved in nurturing the relationship with Greensill, she did sign off on a $140 million bridge loan made by Credit Suisse to Greensill, even after other risk managers raised concerns. The FT reported that Archegos' collapse and Greensill's filing for administration had called into question the risk management process within the bank. Fair enough. Still, by firing Warner, the bank is axing one of the most senior women on Wall Street. Having moved from Lehman, Warner had been with Credit Suisse since 2002, rising from senior equity analyst to head of global fixed income research. Interesting specialty shift. To COO of investment banking, and finally to board member of chief risk and compliance officer. And here you kind of see the various positions on her bio. And sits, or sat, we should say, on numerous boards. Credit Suisse AG, Credit Suisse USA, DTC, Depository Trust and Clearing Board member from, about April of 2017 to present. As far as optics are concerned, it might lead to some awkwardness, especially as the reins to American rival Citigroup were recently taken over by CEO Jane Fraser, the first female CEO of a Wall Street megabank. So as the FT explained, Gottstein, shortly after taking over the bank, expanded the remits of both Warner and Chin, which would in theory give him exposure to the scandal. Though the firings haven't been made official, the FT said the bank is expected to announce their departures as soon as Tuesday morning. So yes, time to pay the piper, and of course today we get this. Oops, let's blow that back open here. Convexity is always lurking. Here's how Credit Suisse managed to lose $4.7 billion in the Archegos debacle. This out of Harley Bossman at the Convexity Maven at Simplify Asset Management. Says the hopefully last shoe dropped on the collapse of the Archegos hedge fund, with Credit Suisse closing out their positions in VIAC, Viacom, VIP, and Fitch yesterday. Says, so how did they manage to lose $4.7 billion? Here is my back-of-the-envelope guess. Brokers are usually restricted to lending only 50% of a security's value. So, with a Viacom close on March 22nd at $100.34, they could lend $50.17 or be at risk if Viacom dipped below $50.17 before they could collect a margin call. Rumor is that some firms were using swaps to offer 5 to 1 leverage, which is the equivalent of lending 80% versus a margin deposit of 20%. So using this math, the client posted $20.07 and the broker lent $80.27, which means that the broker was on the hook below $80.27 until they could collect on a margin call. Now, for risk purposes, this can be replicated as the broker being short the $80 strike put with a 1-week expiry, the time to satisfy a margin call. So this option was worth about 15 cents on March 22nd, but that assumes one can trade 34 million shares at around 7% of the float in a single trade. The more realistic risk replication is 1 to 2 month option. Think Lehman Brothers. So the short option can be modeled at about $5. Consequently, the broker is effectively short a Viacom put option on 34 million shares with a strike of 80. If they closed out the ticket at $42 a share, roughly, an option price of 80 minus 42 equals 38. That would create a loss of $33 per option. 38 minus the 5 there. So 34 million shares times 33 equals about 1.122 billion. Repeat for the other positions, and there you have it. It's never different this time, since short convexity is always lurking near the scene of the crime. So, in a nutshell, that kind of explains what exactly happened. Again, they got caught, they over-leveraged, and of course, probably just a little bit too much risk. But nonetheless, had it gone the other way, of course, we'd be reading about their financials being oh so great in the next quarter, I'm sure. Alright, so that being said, I'm going to take you back here to a piece I did back around December of 2018, one I called You Are Witnessing Watching the Systematic Destruction of the Old Guard. You may remember this, but at the time I was talking about the derivatives, and let's take a quick listen here. They opted to pocket the change.
Of course.
Pretty sick.
Yeah.
So, aside from that, there's some other headwinds in the market, and I love this graphic that came through, I think probably October, November of last year. They do a great job of putting these visual things together here. And I want you to look right dead center of there where it says each square this size is worth 100 billion. And you can kind of read down the side as they go along here. And this highlights all the various types of financial instruments. I just want to do this to give you a little perspective of what we're talking here. You know, as much as we're talking billions in terms of what GM is faced with, and multiple billions with multiple corporations and headwinds they got, take a look at this. So there you see silver, crypto, the biggest companies like Berkshire, Microsoft, Alphabet, Apple, etc. And again, each of those squares represents 100 billion.
Wow.
Flashing down, 50 richest people. And again, I've carried that graphic down just for perspective's sake. And there you see Gates, Bezos, Buffett, Zuckerberg, Ma, Musk, those guys on the side. We see state of California, the Federal Reserve balance sheet, $4.5 trillion from 2008 to 2014 by way of all the quantitative easing programs. We see the currencies, gold, the stock markets, and you can see how this continues to build. We're not talking billions anymore, we're in the trillions.
Yep.
Global money supply, on what they call narrow versus broad, adds more trillions of dollars. And global debt, we start getting into that. China debt as a percentage of GDP, how that's escalating. That's emerging markets. Then we get into global real estate, highlighting furthermore. And then we start getting into derivatives. Now, what are derivatives, you ask? It's a contract between two or more parties that derives its value from the performance of an underlying asset, index, or entity. And if you've ever watched the movie The Big Short, it's a great movie to watch to kind of wrap your mind around these side bets that go on. And the way I look at it is this: the further away you get from the truth, it kind of follows that saying, the same is exactly true here. The further you get away from gold to just a regular dollar as fiat currency, and you get into these machinations and derivatives and whatnot, uh, you can quickly see how these things are going to go and what's going to happen when that stuff finally unwinds. So that's the derivative market. A little bit further down, keep in mind each of those squares represents 100 billion. A little bit further down. Now the best estimates say it's about 544 trillion, but there's others that say on the high end it's 1.2 quadrillion. They really don't have any idea. And we're still scrolling.
That's such an obscene amount of money.
Yeah, and that's the money project. But just for perspective's sake, that's all the derivatives on that particular chart. Just a ridiculous sum. And I did try to keep the little graphic with each square represent 100 billion off to the right there in perspective of just how small that is relative to that. So we've got some major headwinds ahead of us. So that gives you a little bit of an idea. Again, perspective. This was back in 2018. That particular graphic, like I said at the time, was pulled together, I think, in 2017 out of the Money Project. My guess is it's probably spun up even farther than that at this point. Some now 4 years later. So again, you can imagine the spark, the impetus it would take for one of these little hedge funders that is over leveraged one of these guys, how easy it'd be to just yank these banks down. And so again, one might ask, are we on the precipice here? Well, I don't know, but here's case number 2. Greensill Gonzo, political questions need to be asked. This dating back to the beginning of March here. Says yesterday we detailed the rise of a rapid fall of Lex Greensill, the so-called king of supply chain finance, as major partners pulled funding amid questionable valuations in the illiquid investments the fund parlays in. This morning, things have escalated as, following Credit Suisse, again, here we are, Credit Suisse, and SoftBank's decisions to abandon the fund yesterday. Swiss asset manager GAM Holdings is closing the GAM Greensill Supply Chain Finance Fund to subscriptions and redemptions as a result of recent market developments. It added, a certain part of the fund's assets is currently subject to considerable uncertainties with respect to their accurate valuation. Greensill said it acknowledges the decision to quote-unquote temporarily suspend the funds, adding, we remain in advanced talks with potential outside investors in our company and hope to be able to update further on that process imminently. The Wall Street Journal reported earlier on Monday that the parts of Greensill in which Apollo is interested could fetch $100 million. But as Bill Blaine notes, the collapse of the supply chain finance firm will come as little to no surprise to anyone who has looked at their deals over the past few years. I was pulling some other highlights here. It says when CSFB pulled its financing Greensill's lines on the back of uncertainties with respect to accurate valuations, it was clear Greensill's trick of financing the Gupta empire was busted. Deals were truly extraordinary. The reality is any financing deal should boil down to simple facts. Then there's this guy. It says, moreover, the British Business Bank has now stripped Greensill of government guarantees related to massive loans made to Gupta businesses under the Coronavirus Large Business Interruption Loan Scheme, CLBILS. So this is where things get interesting because now this is tied to old coronavirus loans. Interesting. A few months ago, I commented that it was extraordinary how a Gupta company with a tiny number of UK-based employees had secured hundreds of millions of CLBILS financing. Interesting. I'm also intrigued by the Scottish connection. One more point says if questions are going to be asked about political connections and how the Guptas and Greensill got away with CLBILS funding, it may also be worth asking what Scotland's government knew. I was never ever able to trace down details of how the Scottish government guarantees were determined. So I wonder if the local MP can help. Just happens to be Ian Blackford, the leader of the SNP in Westminster. So this is where things start to get rather interesting and tying into the UK. Then we flash over to about March 8th. Greensill files for administration. who's left holding the bag. Says as was expected and detailed most recently here, Greensill Capital has filed for administration in the latest stage of the unraveling of a SoftBank-backed company that had sought a $7 billion valuation last year. The Financial Times reports that lawyers for Greensill appeared before a UK court on Monday in a move that potentially paves the way for the U.S. investor Apollo Global Management to buy some parts of the ailing finance group's business. Greensill has fallen into severe financial distress and can no longer pay its debts, lawyers for the company said in court documents. And of course, if you and I tried to do that, folks, oh no. We'd be debt serfs forever, and they would probably steal your kids and house and everything else in between. But because, this is just a hedge funder or global management stuff, it's just whatever. No biggie, right? We'll bail you out on down the road. Greensill's lawyers said on Monday the company was thrown into crisis last week after its main insurer refused to renew a $4.6 billion contract, which caused the real crunch, though we suspect the Credit Suisse freezing $10 billion of funds linked to the firm did not help. The big question now, especially with the ECB sniffing around, is who will be left holding the bag? So Bronte Capital's John Hempton has some ideas. Says there's been some much fabulous reporting in the lead up to the collapse of Greensill, the eponymously named Australian domiciled but London headquartered supply chain financier. But if you want guidance, start with anything by Duncan Maven from the Wall Street Journal or Robert Smith, sometimes with Olaf Storbeck at the Financial Times. The excellent work of these journalists is now on the front page above the fold. It is not every day a globally significant financial institution fails, and it is rarer still that this collapse happens within a couple of percent of all-time highs in markets. Says there has been remarkably little coverage of where the losses, which will be enormous, will sit. I do not know either, but I am a short seller at heart, and trying to work this out seems like a core task to me. So let's flash forward a little bit. Lex is a controversial and aggressive factoring supply chain trade finance financier, possibly the most controversial one in the world. He's an Australian, bought up on a farm near Bundaberg in Queensland, and the parent company is Australian domiciled and still has a Bundaberg address. The enterprise, however, is vast and by far the biggest company headquartered in Bundaberg. The official version piles on the humble origins. Carrying on, Greensill is controversial. They finance the fraudulent NMC Health. Now, I don't know too much about that, but let's break this down a little bit. Says more publicly, they were involved in the collapse of the GAM funds that was widely publicized. In that case, the fund manager, Tim Hayward, overloaded his fund with Greensill paper at valuation some considered questionable. You wouldn't think there'd be questionable valuations, would you? In the age of unicorn IPOs, and now we have SPACs and NFTs and everything else at the moment? Nah, say it ain't so. Since Hayward's fund collapse, there have needed to be new large-scale sources of finance. The biggest of these is that Greensill bought control of a tiny and failing German bank, recapitalized it, took a huge pile of broker deposits by paying about 100 to 120 basis points over, and either bought Greensill receivables or pledged bank assets to get letters of credit capacity to support Greensill activities. The annual report for the bank, alas in German, is attached. The bank assets are largely insured, quote unquote, but we cannot tell who they are insured by. And there's some portfolio stats, etc., etc. We won't get into any of that, but surety bonds, trade credit insurance, or the liability for future claims against some of the policies will exist until expiry of the policy is highlighted there. Let's see, I have some hypotheses. Either, one, an amount at least $4.4 billion, but possibly much higher, is insured by IAG. Given the size, say $50+ billion, and controversy of Greensill, this is potentially a solvency risk for IAG. 2. Greensill is faking IAG insurance policies, and the amounts are not insured by IAG, but Greensill says they are, in which case a German bank taking all those insured bonds is facing solvency risk, and you should be talking to your German counterpart. And 3, the Credit Suisse documents are fake. I think this unlikely, but cannot dismiss it. Either way, it is one of the uglier situations I have seen lately. So again, that's starting to unwind. That's some of the better parts of that particular article. Flashing over to March 10th, Credit Suisse launches probe into collapsed Greensill trade finance funds. Says roughly a weekend and a half has passed since Credit Suisse gated funds containing $10 billion in assets packaged by Greensill, the troubled financial innovator that suckered in former British PM David Cameron. Interesting. SoftBank and legions of clients and investors with its stated mission to democratize supply chain finance. Now that the trade finance emperor has fallen, having filed for administration earlier this week, Credit Suisse is starting the arduous process of convincing regulators and its clients that the bank is taking steps to ensure that something like this never happens again. In keeping with its scandal response playbook, the Swiss megabank is launching an internal investigation, kind of like it did after the corporate espionage scandal with which felled its former CEO, Tidjane Thiam, to determine exactly what led to the bank getting involved with Greensill and turning a blind eye to the trade finance assets' concentrated exposure to Greensill clients like Sanjay Gupta's GFG Alliance. So it continues, says additionally, Finance News reports that the bank has suspended or fired 3 top executives from its asset management arm. They included Michael Degen, head of asset management in Switzerland and EMEA, who is being replaced in the interim by Filippo Rima. Luke Mathis, head of fixed income in the unit, and another manager who ran the funds were also suspended. So if you're keeping track at home, between the 2 scandals, as it were, that's at least 6 high-up financial folks net out of Credit Suisse alone. Not looking too good for old Credit Suisse. Says Credit Suisse gated the Greensill-linked funds earlier this month after Greensill's main insurance supplier refused to cover new notes issued by the firm, deeming them too risky. It soon emerged that these assets were heavily exposed to the struggling industrial empire controlled by Gupta. Credit Suisse gated the funds because the bank said without the insurance coverage, the Greensill assets had become impossible to value, which is just a fancy way of saying they might just be worthless. So the bank is now liquidating the strategy, a group of short-term debt funds for which Greensill had provided the assets and which had been held up as a success story as recently as December. Funny how that works. Everything's all good and hunky-dory until it isn't. The money pools are returning most of their cash and equivalents, though about 2/3 of investor money remains tied up. Many of the assets in the funds have insurance protection to make them more appealing for investors seeking alternatives to money markets. But the second biggest of them, the high-income fund, doesn't use insurance. It's also the fund with the least liquidity, with less than 20% of the net assets in cash. That being said, it says, last but not least, it almost makes one wonder how Greensill ever managed to develop its reputation as a leading fintech champion. Sure does, doesn't it? Or is it by chance that these big banksters and their illustrious clamor and greed for profits turned a blind eye to risk and just went after it anyway? So that being said, let's flash forward to March 17th. Well, now Deutsche Bank, Commerzbank on the hook for 500 million euros in Greensill collapse. So here's the 2 German banks. Says just months after Germany's financial regulator was exposed to being asleep at the wheel during the Wirecard scandal, which yet another scandal still playing out, both Deutsche Bank and Commerzbank were reportedly about to be on the hook for millions of euros of losses tied to Europe's latest financial disaster, the collapse of Greensill Capital and its Bremen, Germany based banking arm, Greensill Bank. Germany's regulator, BaFin, which was slammed for dropping the ball on Wirecard. At one point, the regulator accused a reporter for the FT of conspiring with short sellers to discredit Wirecard. In the end, the paper was vindicated. Warned Tuesday that a handful of German banks that backed Greensill will examine depositors' claims and pay out anything that might be owed under a national deposit insurance scheme. A German court in Bremen opened insolvency proceedings into Greensill earlier on Tuesday at the agency's request. The Bremen local court appointed Michael Frege as the insolvency administrator. Frege, an attorney at law firm CMS, is one of Germany's best-known administrators, having granted notoriety from handling the insolvency of a Lehman Brothers unit and the dissolution of Maple Bank in 2016. It says while dozens of German municipalities are at risk of losing some or all of the money they have deposited with Greensill, Deutsche Bank and Commerzbank will be left holding the bag because they're two of the biggest members of a voluntary deposit insurance scheme run collectively by Germany's commercial banks. Although it's too early to say how much they might owe, a payout from the fund would force the surviving members of the scheme to cough up more cash. One German media outlet, Manager Magazin, reported that Deutsche Bank and Commerzbank will each have to contribute $200 million to $300 million to cover deposits at the collapsed bank, sums that encapsulate their shares of the damages from the deposit insurance scheme. Neither bank was willing to comment about their prospective liabilities. Bremen-based Greensill Bank had about €3 billion of assets of insured deposits, an additional €500 million which aren't covered. The latter includes funds placed in the bank by German municipalities, which, as we have reported, are expected to be wiped out. So, not good for those municipalities at all, obviously, but nonetheless, you can kind of see where this is headed. Next up, we get the collapse of Greensill, unwise enablers, and a dearth of due diligence. And so, interesting piece here by Bill Blaine in his Morning Porridge blog here says, all that glitters is not gold. If I take that bet, I am sure I'll end up with an earful of cider. Says the collapse of Greensill involved a predictable cast of unwise enablers, but it should serve as a warning to the growing number of alternative asset buyers on the dangers of complex deals which promise much but deliver less. Due diligence is critical in the highly illiquid alternatives sector. And by alternatives, think back to the graphic I was just showing you of derivatives, all these fancy packages of stuff. All that glitters is not gold. And again, when things go bad, the bets go bad, well, somebody's got to pay the piper. Says you really can't make it up when it comes to the collapse of supply chain charlatan Greensill. I suspect it will make a great film. It should also send a judder down our spines, reminding us things are seldom what they seem in complex structured finance. I'm wondering how many fund managers are quietly nervous about what's really in their alternative asset/direct lending investment buckets this morning. If I was a holder of complex European securitization receivable deals that promise much but actually provide very little information on the performance of underlying assets, then I might suddenly find an anxious desire to check just how they are really doing. At least former UK Premier David Cameron will be happy. A majority comprising Tory MPs on the UK's Treasury Select Committee blocked an inquiry into Greensill yesterday on the basis it may be politically influenced. The fact Call Me Dave was texting Chancellor Rishi Sunak pleading for GFC to be a special case for COVID bailout loans says it all about the dangers of lobbying. The S&P will be equally delighted at the lack of scrutiny of dodgy dealings up in the Highlands. The Greensill collapse is unlikely to be the last time financial chicanery is exposed as sham, and that is why holders of European alternatives and asset-backed transactions should be nervous. The lesson of the Greensill deals are multiple. Don't assume the deals you are sold are what you are told they are. There is no substitute for deep due diligence. Companies that look impossible to finance do not suddenly become AAA credits after a sprinkling of magic-secured funding dust. Interesting. It says anything promising of low risk, high returns from complex structuring and technical innovation is suspect. And it says let's review the unfolding Greensill mess. There are over 1,000 holders of the $10 billion plus of defaulted Greensill investment structures packaged and issued by Credit Suisse, which marketed them as ultra-safe secured investments. Under the law, what the holders recover on these deals will rather depend on how much the administrator and the courts can jimmy out of Sanjay Gupta's dead firm walking steel and commodities business, GFC Alliance. I have no hesitation in saying GFC will go to the wall. There can't be a single sane financial firm on the planet willing to finance them as the story of its Greensill relationship emerges and its connected in-house banking arrangements become clearer. Although apparently a state rescue is under consideration to save jobs. Aha! Of course, you always have to have the government to the rescue because they are just, we gotta have them. Too big to fail. Investors will be lucky to see much more than 30% recovery already in the pot from non-Gupta related investments in the Greensill funds, but Credit Suisse may decide to make its investors good. The reputational damage of seeing their private and investment banking clients clobbered for their stupidity, which would negate their private banking brand, may mean it's worth taking the hit. No wonder Credit Suisse staff are very grumpy about their bonuses. Successful financial scams require willing participants. All the usual fools are there in the mix. So again, one question is, how did Greensill get away with it so long? As it was clear in early 2017, there were major issues with some of the supply chain financing deals Greensill was putting together. Gee, shocker. It's never a problem until it is a problem. The only way you should participate in alternative type deals is by knowing exactly what's going on. And yes, my day job is head of alternative assets. Happy to discuss in depth at any time. So last but not least, flashing forward to old David Cameron here on the 25th of March, says former UK PM Cameron faces investigation for violating his own lobbying sleaze laws in Greensill deals. So, whoops. Doesn't pay, I suppose, to be on the opposite side of something that you actually lobbied and signed into law, I suppose. But former Conservative Prime Minister David Cameron has been well and truly hoisted by his own petard. Earlier this month, the Financial Times revealed that Cameron, who took a job as a senior advisor to Greensill after resigning from number 10 Downing Street in the aftermath of the Brexit referendum, unduly pressured some of his former Conservative Party colleagues like Chancellor Rishi Sunak to help hook the company up with the government loan programs intended for struggling SMEs. While the company didn't receive any money, news of the repeated Cameron-influenced appeals that it received infuriated readers. Now, the Times of London is reporting that Cameron is facing an official investigation into whether he violated lobbying sleaze laws that he himself brought in during his stint as PM over the lobbying effort mentioned above. David Cameron is being formally investigated over a possible breach of lobbying sleaze laws that he brought in while he was Prime Minister. Treasury figures allege that he directly lobbied the Chancellor to secure multi-million-pound COVID loans for Greensill, a finance firm he was advising. Cameron also approached the Bank of England in an attempt to secure Greensill's participation in the loans program. Such interventions may fall foul of the legislation that forbids third parties to directly lobby ministers or senior officials without declaring themselves on the government's official register of lobbyists. Failure to register can lead to a £7,500 civil penalty or, in severe cases, criminal prosecution. A spokesman for Harry Rich, the registrar who polices the lobbying rules, confirmed that Rich and the office were launching an official investigation. The registrar is investigating whether David Cameron has engaged in unregistered consultant lobbying. He said Cameron is expected to say he was an employee of Greensill and his actions were outside the scope of the law. It says during yesterday's appearance before the Commons Liaison Committee, PM Boris Johnson faced questions from opposition lawmakers about whether Cameron's lobbying effort stretched all the way to number 10. So far, there's no evidence that it did, though Cameron reportedly lobbied people close to the PM. But if that should change, Bojo could quickly become ensnared in the burgeoning scandal. For those who haven't been closely following the Greensill saga, Bill Blaine penned a helpful overview, one we just covered there, says the other day that took the trade finance firm's enablers, including Cameron, to task. Greensill collapsed earlier this month after its main insurer canceled coverage on some assets packaged by Greensill, which prompted Credit Suisse to gate trade finance funds with $10 billion in assets, saying that they had become impossible to value, in effect, potentially worthless, without the insurance coverage. Says while the PM certainly appears to have insulated himself from the scandal, the involvement of people in his orbit could create problems for Bojo going forward. His Chancellor Rishi Sunak has already been dragged into the mess thanks to Cameron's lobbying. It makes us wonder which senior HMG official will be next. So again, folks, at the end of the day, where do both of these go? It's hard to say. Other than, are they potentially canaries in the coal mine of the Great Unwind? You know, we've talked on this channel here about the Great Reset, the World Economic Forums, the Klaus Schwabs, the Davos type, and what they would like to see happen. But, you know, at the end of the day, before they can have the Great Reset, can you necessarily have all the old guard still in place? Or do you have to bring it all down at some point in order to build up from the ashes, kind of like a phoenix rising, right? Isn't that kind of their symbolism at the end of the day? So, I think this month is going to be very, very interesting to watch to see how things play out. Are there going to be more cases of Greensills or Archegos? Maybe. We'll have to see. Which is a good lead-in into my last piece here, and why I think this month is going to be very interesting to watch. And it is this. It's a piece by Greg Hunter out of USA Watchdog dating back here a few days. Or he had a gentleman on by the name of Bo Polney. Says, greatest time point in history coming April 2021. And I happened to catch this on, I forget where I was watching this. Saw a bit of a clip out of that particular broadcast. But nonetheless, some very interesting things playing out here. And you remember a certain intelligence apparatus telling us it was going to be biblical. Well, feast your eyes on this. As a biblical cycle expert and financial analyst Bo Polney says we are approaching the greatest time point in human history near the end of April. Says in the last year, Polney has calculated time points in big events such as his prediction of a new era of time that would unfold after his February 2020 interview. It certainly did with the age of COVID lockdowns that started in March of 2020. Polney also predicted a 35 to 40% decline in the stock market in mid-2020. The market sold off 38%. Polney also predicted something epic would happen on September 18, 2020, and that was the day Supreme Court Judge Ruth Bader Ginsburg died. So, what is Polney's cycle analysis telling him now? Polney says what started in 2020 will end in 2021, and we have related that actual cycle to Noah's Ark. Says when oil went to zero, April 21st, 2020, that would equate to when the door was closed on the ark. This is a time when Noah is on the ark and he doesn't step off until April 26th, 2021. The world we are presently stepping into is the new era, and it does not start until April 26th, 2021. And right now we are in transition. The greatest time point in history is about to happen. Polney says there are other biblical cycles ending as well in 2021. Polney explains, one of the cycles that we are following is called the Red Sea Moment, and the cycle time point for that is April 25th, 2021. Says this is when Moses parted the Red Sea to escape from Pharaoh in ancient Egypt. So we are about a month away right now, and what will happen, I don't know, but it is truly fascinating that things are happening right now at the Red Sea. A massive container ship currently blocking the Suez Canal, and the United States is replaying biblical cycles. April is going to change our world forever. It says, then there is the 50-year debt jubilee concept talked about in the Bible. The U.S. dollar was taken off the gold standard by President Richard Nixon in August of 1971. August 2021 is the 50th year. Polney says God is going to force the hand of this event. So, when the dollar drops sizably in value, expect an immediate reaction, and the immediate reaction would likely be some type of a war event. Says, what about Bitcoin and the US dollar? Polney says Bitcoin is up $40,000 in God's new year, and we are in the 50th year in the Jubilee cycle. So this year the dollar itself is supposed to tank. When it drops, that's going to be the fuel for Bitcoin and the cryptocurrencies to accelerate even faster vertically. We have talked about this before, and I have said the price point for Bitcoin could be over $200,000 in 2021. The price moves we have seen so far are only preliminary pricing for what is still coming for Bitcoin. Wall Street is front-running the trade and piling into Bitcoin because they know something. It says, what about gold and silver? Well, Polney says when gold and silver go up on this move that's coming, this move coming for precious metals will destroy the banks. It will destroy the financial mechanisms that are in place right now. When it starts to destroy the mechanisms used to hold down precious metals, that's going to cost them billions of dollars a minute when gold and silver start to skyrocket. So they are doing anything and everything to not let precious metals go up. There is a point of time coming, and it is based on Leviticus 25:9. It specifically talks about the 50-year Jubilee cycle. That event is going to cause a drop in the value of the US dollar. That event is going to cause a Jubilee cycle for precious metals where they lift off and go vertical. On President Trump returning to office, Polney says cycles do nothing more than replay themselves with different characters. Look at Saul and David. Saul ended up chasing David out because he knew he was anointed. David ran and hid in the wilderness, and basically he was hiding. What did they do to Trump? They chased him out of the White House. As in David, he was chased out, but chase him out all you want, he was still anointed. We are replaying history with different characters. In this case, Saul is Biden, and Trump is David. But when Saul falls, David returns. That's what's coming. In closing, Polney contends that God will not turn over America to evil. Polney predicts America will not fall. God will not forsake America. So, interesting take. And again, looking at how things are unfolding here, the kind of the lead up to it, granted I just kind of took you through a little bit of what has been going on behind the scenes from March to this point. It's possible. There are a number of things playing out. There are some things still going on with the Ever Given ship. Not really heard too much in the mainstream media, Mockingbird media. Probably won't hear too much out of it, even of the alternative media, independent media at this point. But some interesting things playing out there. There are some other interesting timelines coming up in April as well, some of which I have seen related to an independent analysis group and that has been hired to look at all the quote-unquote anomalies of the election. And supposedly between the 10th and 20th of this month is when they're supposed to put everything forth. All the data is supposed to be made public. And there's not a damn thing anybody can do about it other than try and prevent its release, probably. So, again, this month is going to be very, very interesting to watch. Keep your head on a swivel, certainly. I'm going to be keeping my eyes on the financial side of things here for any sort of leading indicators and the like, and try and stay on top of that. So, that's... Yeah, that's right. You just call it BS. But nonetheless, those are some of the things that I'm watching here behind the scenes, and that's all I've got here for tonight. I may be back in the morning. Got some other interesting things playing out here, financials today, but I wanted to get this piece out first. So look for me again in the morning. I may have some more on that, and then, of course, tomorrow, Wednesday, we'll have our normal Wednesday lineup over on the 5x5 channel. So we'll be over there at 3 p.m. Eastern for that. So that being said, that's going to do it for this edition of Midnight Rider. I appreciate you guys tuning in. And again, just as a reminder, we've got Trovo up and Vaughn live up too, should something happen. Some backup channels there. And that being said, take care. God bless. We'll see you next time, folks.